Hi, folks. Today we're going to talk about business expenses, and we're going to approach it from the perspective of looking at the actual tax law. So, we're bringing this subject up. I recently had a client tell me, I feel that you were too conservative in the way that you dealt with expenses, and I felt that other accountants might have taken those expenses. And he's probably not wrong in the sense that other accountants might have taken those expenses. But remember, the word accountant can be used without any consequence. Just because a person calls themselves an accountant does not mean that they are credentialed or that they are qualified. Anyone who prepares taxes at an H&R Block or a Liberty can call themselves an accountant. But the reality is, all they've done is paid $20 to get what's called a PTIN number. That doesn't mean that they necessarily know what tax law states. While we're not attorneys here, we are enrolled agents, and so the IRS does give us the same rights that they give to CPAs and tax attorneys when it comes to representation, because we have studied the tax rules around business deductions. So we're qualified to state what is and is not a business expense. That being said, we're going to go to our safe harbor statement. We always want to remind folks that the information contained in this presentation should not be relied upon as definitive tax or financial advice. Rather, you need to consult with your accountant and or your financial advisor. I may be your accountant, I may be your financial advisor, but you should still not act independently. Based on the information here, you need to discuss this with me first. So let's talk about our learning objectives. So we're going to discuss three different code sections from the Internal Revenue Code. We're going to talk about Section 162, which is the section that deals with trade or business expenses. So that little squiggly line, that's section. Section 167, that deals with depreciation. Section 6001 deals with record keeping. And then, of course, we'll have our traditional review. So let's go ahead and we're going to jump into trade or business expenses. So, what are we talking about here? Well, trade or business expenses are described in Section 162 of the Internal Revenue Code. It is the legal provision which allows the deduction of all ordinary and necessary expenses paid or incurred during the taxable year in carrying on any trade or business. Now, why is this important? Well, the U.S. tax code as written says that all income is income unless otherwise excluded by tax legislation, and all tax legislation is grace. So, what that means is any money that you get is technically income unless an exception exists within the U.S. tax code. There is no such provision for expenses. So Section 162 is that provision that says all necessary and ordinary expenses that you pay or incur during the taxable year in carrying on a trade or business can be deducted against that trade or business income. That sounds like a lot, but said in a very simple way, if you have a legitimate business expense, the chances are you will be able to deduct it. Going into the next screen, why that matters? Well, obviously because these deductions reduce your income. We like to point out that Section 162 allows for any business, regardless of whether or not it has an entity, regardless of whether or not you've registered it with the Secretary of State, with your local authorities. Any business that you are carrying on with a profit motive can deduct expenses. That being said, carrying on business, that's the word that's used within the code. That's not wordplay. So we can't make a business and just make a bunch of expenses and write them off. It's not just having a business, it's carrying on a trade or business, which means you are actively involved in carrying on business. You're doing work. So if you are doing work with the legitimate purpose of making money, then yes, some of those expenses that you have, most of those expenses that you have, will be deductible. There are some exceptions, however, in the sense that some expenses have specific treatments or requirements which are written in tax law that you must meet in order to deduct them. And we're going to go over one major category of these expenses now, and that's depreciation. And depreciation is introduced in Section 167, but we're going to go back to Section 162. In this section, it specifically states that expenses must be paid or incurred during the taxable year. It also specifically excludes payments for property to which the taxpayer has equity. So let's think about that. You go out and you buy a car for your business. Well, you have equity in that property. Tax law excludes those payments because you have equity in the property. In other words, you can resell this property. However, or I should say Section 162 excludes it. What Section 167 does, it allows you to take a deduction for the value of that property across its lifespan. And this is an accounting concept known as depreciation. So it allows you to take deductions for the value of the property that you've purchased, for the book value of it. But you have to stretch that value out over the lifespan of the property. And those lifespans have been determined already within tax law. So, why does it matter? Well, if this sounds complex, that's because it is somewhat complex. Although we do admit modern software has made it significantly easier, the reality is that software is only good as the inputs you give it. So, as the user, you need to discern which is the correct lifespan, which is the correct method. And you need to provide accurate usage dates in order to calculate the correct amount. There are a lot of factors that the user must input for the software to calculate it. So, user error and depreciation is very common. Furthermore, sales of depreciated property may require special income recognition rules, even if you didn't take depreciation. One of the most commonly missed forms of depreciation is depreciation on rental properties. If you turn around and sell that rental property, the tax law requires you to take a special class of category of income for that depreciation that you didn't take. So, in other words, you lose out on a deduction if you don't do it right. Um, that's why it's very important that you have someone who knows what they're doing, or that you know what you're doing. Lastly, purchasing depreciable property, I should say, is one of the single biggest tax planning strategies that a business owner can use. So you need to think about what you're purchasing. You need to think about the timing of it. And you need to think about rules around special or bonus depreciation. By doing those things, by making sure and purchasing in the right time, in the right year, thinking about your income and how lumpy it might be in terms of one year to the next, all of that is a factor that you need to be considering when you decide when you're going to purchase and put into property, or put into use, I should say, depreciable property. But now let's get into what probably more business owners have questions about than anything else, and that's record keeping. So, what it is? Well, Section 6001 places the onus on taxpayers to keep proper records to support their deductions claimed on tax returns. In other words, you can't just write it off and say, but I spent it. Nor can you just say, well, I have a credit card receipt or a bank statement showing that I spent it. You have to have more than that. You have to have itemized receipts or detailed account statements showing what was purchased. That's the gold standard. If you can show them, hey, I purchased supplies, these are the supplies, here's my receipt, or here's my account statement from Costco, from Home Depot, from Amazon, that is sufficient record. Just simply showing that money went out doesn't prove where it went to. And even though you show where it went to, it doesn't prove what you spent it on. So you need to have those records by tax law. Furthermore, there are certain expenses, travel expenses, mileage expenses, and meal expenses, that require daily logs in order for you to even deduct those expenses. If you don't have those logs, you're not allowed to deduct them. And if you get caught doing it, those deductions will be reversed, even if they were legitimate. No, the IRS isn't the one who makes these requirements. Congress did, because Congress is the ones who signed these bills into law, and they have been upheld by the court systems. Therefore, it's not disputable, it's not debatable. If you don't have the records, you're not supposed to take certain expenses. Other expenses you are allowed to take because you are allowed a reasonable allocation. However, if you don't have proper documentation, then that reasonable allocation has to be determined either by you, the IRS, some agreement, or by the court system. And again, for ones where specific record keeping requirements are stated, even if you have legitimate expenses, no allocation is made if you don't have the records because tax law requires it. So Getting into why it matters, it never matters until it does. In other words, it doesn't matter until you get audited. But if you get audited, you are going to need to have these good records to prevent your income from being reconstructed. Or in other words, to prevent the IRS from reversing your deductions for a lack of records. Again, this is tax law. So the IRS has all power in their court. You have the burden of proof. It's not enough to just have bank and credit card statements. You need to have itemized receipts, account statements. Now, this this highlights the importance of having a good record keeping system because it can mean the difference between success and failure for your business. It also highlights the importance of using the right vendors because the right vendors will make this easy for you. Companies like Home Depot, Lowe's, Costco, Amazon, they provide account statements that show your activity, making online purchases rather than making in-store purchases, or on-app purchases for things like Walmart, where they have tracking your history. These things are important that you do. Um, Purchasing in places where you can have an account and they can track that for you is a critical way for you to keep your records in order. And that's critical information for you to have on hand should you ever get audited. So, in review, we talked about expenses. Expenses refer to goods or services that you purchase for business use with a lifespan of less than 1 year. These are generally deductible. We talked about depreciation. These are goods or services that you purchase for business use with a lifespan greater than 1 year. In that case, they may require depreciation, or in the case of services, they may require what's called amortization, which is basically depreciation for non physical goods. And then finally, we talked about record keeping. All businesses must have a proper system of records in order to protect themselves from audit, not just by the IRS, but this is an important point. You also have to be concerned about state and local taxation authorities as well. So oftentimes we talk about the IRS, but the reality is there are also state and local tax authorities who may also audit you, and those same record keeping requirements will apply. So we hope this was helpful. It's a small 10-minute presentation. Well, at least we're at 12 minutes now, but close to 10 minutes. If you have any questions, if you want to know any best practices, if you want us to help you set something up, please reach out. Phone number 404-470-5055. Email steve at cg-advisory.net. You can also go to our website, cg-advisory.net. Thank you.